Hello everyone, welcome to the video. In this video, we will talk about chapter 12, the multiple choice practice. So chapter 12, talking about capital investment decisions and then the time value of money. I put the title there because I think the title is a good summary for this chapter. I summarized my notes here. Feel free to have your own note or summary there. For me, I think there are two main things in chapter 12. First thing is we learn the four measures to decide, um, to help us to decide the capital investment. We also call as capital budgeting. Um, so chapter 12 is a very important chapter. I personally think it's not only just important for the exams, but also important for our daily life. So I personally strongly suggest you to, have a good understanding of this chapter. Make sure you read the textbook also, do all the assignments, think about the concepts. So the first thing we said, four measures to decide the capital investment. You are a millionaire, you are thinking about investing in different projects. You can, invest in an ice cream store, invest in a gas station, invest in something else. So which one should we invest? There are four measures. One is the payback method, one is ARR, one is NPV, and the next one is IRR. So those are the four things. That's the first thing. And then you also need to know the time value of money, which is very, very, very important. I even put the three triangles there just to tell you it's very, very, very important. Payback method and then ARR first, those two things, they don't think about time value of money. So that's one of the bad things. So they can only be used as the very first stage to filter out the bad investment. For payback period, it's straightforward. We said if it's the even cash flow, you just use total investment divided by the expected annual net cash flows. You invested 5,000 every year, you get 1,000 back. It takes 5 years to get all of your money back. It's straightforward. That's the advantage, but disadvantage, two different things. No time value of money, and then we only look at the years, but we don't look at total profitability. I think in my handout video, I give you just a quick example. You can get your money back in some projects, but then after that you don't get any cash inflow. But some projects it may take a longer time to get your money back, but it gives you more money overall. The profits overall is more. But payback method just ignores that thing. And then second one, we talk about ARR. I will just tell you, you definitely will have the calculation for ARR. Make sure you know this one. There is a good practice there. We talk about that later. But ARR is accounting operating income. So this is the only measure using accounting operating income instead of the cash. All the other three, they use cash. ARR using accounting operating income. So how do you get operating income? You have to convert from cash to operating income by subtracting the depreciation expense. So it's kind of like your revenue, your cash revenue minus your expense gives you operating income. How do we get our depreciation expense? Is your cost minus residual divided by useful year. Okay, so we will practice this one later. Make sure you know how do you get ARR. And then we talk about time value of money. Very, very, very important. I don't have my discount table here, sorry, but in my the handout video, I kind of showed you the work. So time value of money is general idea. It's $1 now worth $1 next year. The money will generate money for you. That's time value of money. General idea is you have this timeline is present time is t equals to 0 is current. And every year, the first year, second year, third year, fourth year, fifth year, let's say, you cannot compare $100 here with $100 next year. So you have to discount all the future cash flow to the present. Either use table A, which is just a one time, or table B is annuity. So we have to discount all of the future cash flow to our present value. And then you compare apple with apple. Remember, we talk about example of you won the lottery, you get $1 million, that's present value already, or get 150,000 every year for 10 years. That's annuity. You have to discount all that 10 years cash flow. Or you got 2 million 10 years from now, so you also need to discount use table 1, which is one time, and then you discount that 2 million. Make sure you know that time value of money. You have to know that. And then we talk about the net present value, which is a net present value. You have to get the present value, and then you net them. So the formula, if you ask me, there is a formula, it will be your investment, which is outflow. It's outflow. You invested in like 100,000. Every year you get 40,000. Let's say if there is no residual value, you just discount this 40,000. So your NPV will be negative 100,000 plus the present value of this 40,000 for 4 years discounted back. That will be your NPV. And then we said the maximum price for the project will be all of the total cash inflow of the discounted future money, right? Future inflow. So from this project, you total will earn 20,000. Then the maximum you will pay is just 20,000. You don't want to pay a penny more than the money you will earn. If there is a residual, you discount the extra. The residual is just the extra cash flow. If there is a residual, you discount this extra cash flow to your present value. So your cash inflow has two. One is this annuity of 40,000 for 4 years. The other one is 10,000, just one time 10,000 at the end of the 4th year, you discount it back. And then we talk about IRR, is we say we don't get, how do we get RRR? If we look at the table B, you know, remember that is in the other video, you look at the table, you get IRR is when the NPV equals to 0, when the NPV equals to 0. Okay, so I'm just going to talk about general idea of the summary, and then we look at all the multiple choice together. Our first question is actually chapter 11. Sorry, I already did this. I'm not going to work with you, I think. Just go through the multiple choice with you briefly. We said if you have a favorable fixed manufacturing overhead volume variance, that means that you produce more volume than budget. So you produce the more units than the budget. You have a favorable fixed manufacturing overhead volume variance. You have to know this one for chapter 11. Okay, the next one said which is correct. So the answer, actually I didn't even put the answer is B. Answer A is wrong. We said not all the methods will have the same decision. If you use payback method, the decision may be different from using NPV. So payback ignores the cash flow after the money is recovered. That is from your textbook. Accounting ARR doesn't think about time value of money. We said only NPV and IRR, and the cost of capital is the required rate of return, is not the desired rate of return. Payback is a rough estimate of the time used to recover all of your money. And then it's not about NPV. It's not about your income. Income is only in ARR. Is not the best method for sure. We always use NPV as the best method. We always use NPV. Which of the following is false, right? Which is false. So you have to make sure you choose the false one. Payback method, everything equal, a shorter is better, right? And then we said payback is the length of time it takes to recover all of your money. No indication of the profitability, is only think about the years. This one is wrong. We can only use this formula if it's the equal cash flow, right? We said you can only use it if it's the equal, even, you know, the same constant cash flow. Okay, question 5, we talk about the payback method. I think you should be able to do that one. Investment, you invested 550,000, you get 100,000 every year. It takes about 5.5 years, which is 5 years and 6 months to get your money back. Question 6, talking about ARR. So we said accounting accrual is the ARR, right? Question 7, talking about operating income. That's definitely ARR. Just look at the keyword. I'm not going to read. Make sure you do this first, and then you check your answer with me. Second, question 8, talking about convert your cash flow to the income. We should deduct the depreciation expense. We should deduct the depreciation expense. We should use cash minus depreciation expense to get our operating income. Okay, next one, question 9, internal rate of return. I don't think I will test you this one. I don't think I will ask you the definition honestly, but it's just the interest rate. Basically, it's the interest rate. We have to check the rate, right? The net present value of the investment, I put net cash inflow equals to cost of the investment. So which means your NPV equals to 0. You spend $10,000 and then as investment, but total your income will be $10,000. That was the rate to get that 0 NPV. Question 10, it's a good one, I think, talking about ARR. You definitely will have an ARR question. If I remember my words, definitely will have an ARR. It's operating income divided by investment. We know the investment is 125,000, so I put 125,000 there, and then how do you get the operating income? It's cash minus depreciation expense. How to get depreciation expense? It's cost minus residual divided by years. Our cost is also 125,000. You know, I use the similar color green. Residual is 0. I put 0 there. Can be used for 80 years. So you get your depreciation expense first, and then every year cash is 30,000. So your 30,000 minus depreciation expense gives you every year the operating income divided by investment. 125,000 will give you ARR. Okay, make sure you know this one. Question 11, talking about disadvantage of accounting rate of return is that it talks about the income instead of cash. I don't really think it's a disadvantage, but this question just said, most likely we should use the cash to do the capital budgeting. Kind of disadvantage of using accounting information is we put the non-cash item of the depreciation there. But again, I'm not going to test you this one, just to make sure you get some idea. Question 12, ignores time value of money. We said ARR, IRR, NPV, they use the time value of money. Okay. Question 13, talking about the time value of money. I didn't really talk about this directly, but we kind of got the idea. We said, how do you get the present value or the future value in present value? It's basically your future value. Remember, the lottery is $2 million times your discount factor. So the 2 million will be the principal amount. Discount factor will be your interest rate and then number of period when you look at the table. So you use these 3 things: principal, interest rate, and number of period. So similarly with question 14, you use interest, you use principal, you use number of period to get the time value of money. Okay. I don't think I will test you. I just give you like the lottery. I say, hey, you will get 2 million after 10 years. What's the present value for that 2 million? Kind of something like that. So you just apply that 2 million times the discount factor. Question 15, talking about correct. So we said NPV is positive, we should invest, right? The note is wrong. Internal rate is less than required rate of return. We should not invest. You get money from bank at 10%, but from the investment, you only get 8%. So don't invest, you are losing money. Investment with a longer payback is less desirable, right? If the NPV is positive, we invest. Investment NPV is calculated as I say. I'm not going to test you, just get general idea. NPV is present value of the investment minus minus the investment initial investment minus the initial investment. Don't really like this one. Question 17, we said if it's the same every year, constant cash flow is the annuity. So we just use the present value of annuity table. You can see the multiple choice actually doesn't have a lot of fancy calculation. So just use this one. I would say practice as the basic thing, but I personally think you will have a similar level of calculation with my accounting lab, those questions. Okay, last page. We said the best one is we use NPV, always use NPV. And then we said the IRR is when the NPV equals to 0. And then investment unique rate of return, right? We said the ice cream store, gas station, that is the investment unique rate of return is the IRR, is the internal of this project, the internal rate of return. So as I say, I don't really see a lot of fancy calculation in the multiple choice. I think the main important thing I personally think like ARR, you need to know payback is straightforward. For NPV and IRR, make sure you check your note, check your My Accounting Lab assignments, the graded one at least. You will see similar things there. I think I will definitely put chapter 12 in the problem part. Okay, let me know if you have any question. This video is kind of short. Just email me if you have any question. Thank you.